Third quarter portfolio filings are out, and it looks like Charlie Munger is not selling any more Alibaba. And that was a concern that a lot of people did have because he previously did sell shares of Alibaba. And so I'm going to walk you guys through that. And it looks like this story is largely over. It looks like he's built his position and he's just going to hold the shares. And so while you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. And I wanted to make this video. I know it might be a little bit repetitive for some of you guys, but there were people who were concerned that Charlie Munger may be getting rid of Alibaba. And you know, it really shouldn't matter for your investment thesis whether or not he holds it or not. It didn't matter for my investment thesis whether or not Manish Prabhai held it or not, or if the whole media turned against investing in China. What matters is my research, my diligence, and what I think about it. But I do want to walk you through this. And so you can see here that Charlie Munger's, as of Q3, with at least the Daily Journal portfolio, they still hold 300,000 shares of Alibaba. And of course, the reported share price is now down to around $80 per share because they did do tax loss sellings, which they rolled up into the reported price. And so how did that work? Well, you can see that Charlie Munger started buying shares of Alibaba Group in Q1 of 2021. He added in Q3 of 2021, and then he added in Q4 of 2021. But notice that the 302,060, that number of shares, coincides with the number of shares that he purchased in the first two transactions. So the 165,320 and the 136,740. And so effectively what he did was he took a loss on those shares and he rolled it into the cost basis of the 300,000 shares that he purchased in Q4 of 2021. Now, if I actually got that wrong, guys, let me know in the comments below. In Canada, it works a little bit differently. You have sort of like an average cost basis, but it looks like you can do that in the US. And recall, guys, that when Munger cut his position by 50% in Q1 of 2022, many thought that he was reversing course. And it turns out, like I just showed you guys, he wasn't. His 13F filing revealed zero changes in his portfolio overall. He still owns 300,000 shares as a whole. It looks like he was just simply tax loss harvesting after reducing his cost basis in previous quarters. So it doesn't look like Charlie Munger is going anywhere. And if that comforts you, I'm glad it does, but it really shouldn't, because at the end of the day, you should be building out your own model in Alibaba, and you should have an understanding of what the thesis is. Now, my thesis in Alibaba is a two-pronged approach, which is what I want to walk you through just quickly in this video. And overall, the main part of the thesis, and this is what I think everybody should hold, is that the big item of Alibaba is the fact that they are a large company and they own many businesses in that China commerce segment. Now, I have mentioned previously that this segment accounts for around 70% of their revenues and 100% of their operating cash flows. And so in here you got Taobao, Tmall, you got Taobao Deals and Tao Sai, which are growing really fast. And of course, you have the Fresh Hippo brand, you have Sun Art, etc. Also, you have their 1688 wholesale business. And the other area that's growing very fast, I probably should have highlighted international commerce as well because it's doing well as well. But the other area that's growing very fast is the cloud business. And so there are two distinctive segments of this business that hold a lot of value. I mean, you're effectively paying for about a third of the China commerce segment, and then you're getting everything else for free. That's ultimately my theory, or the reason why I'm holding shares in Alibaba. And one thing that I do got to remind you guys of is they're going to be having their Alibaba Investor Day for 2022 soon, at least I hope. But if you haven't checked out their Investor Day materials, please take a look at it. I also did a 10-part series on their Investor Day materials from 2021, which I will link to the end of this video. But I want to show you a slide from this deck. So this was their second day of their Investor Day. It's part of their cloud presentation. But I do encourage you guys to read all of each one of these decks. And they put out, it looks like 8 presentations for their Investor Day. Now, if you don't want to read all of their investor decks, no worries. I covered them in detail in the group of videos that I will link at the end of this one. And so if you want to just sort of lazy your way through it, you can just watch the videos. I dug into them in a lot of detail, but I also added additional detail to help you understand Alibaba. I love the fact that Alibaba is so complicated. For a guy who likes to do research like myself, I really enjoy when the companies are super complicated from the perspective of business units, not necessarily business models, because if I can't understand the business model, I'm just not going to invest in it anyways. Now, here's that slide. So ultimately, they expect the Chinese cloud market to grow at approximately a 37% CAGR. I expect them to update that in this year's investor day. So we'll see if they bring this down. I do expect them to bring it down, but who knows? But if you decide to grow Alibaba cloud segments near the 5-year CAGR for China, I don't think that you'd be wrong, but I've become very conservative here because I think there are risks in the cloud business in China. And what I mean about those risks is McKinsey & Company is actually pointing out what I've been talking about on this channel for a long time, which is that it's uncertain how much annual growth state-owned cloud service providers will gobble up from the private enterprises like Alibaba. Recall, guys, doing business in China is a whole nother beast, so you got to be aware of this stuff. So it's prudent to remain conservative until proven otherwise. I am eagerly awaiting for Alibaba Cloud to discuss their future growth expectations with respect of this additional risk. So now look, McKinsey by 2025, they're expecting both segments, the private and the public, to grow in unison, and the traditional services to just become smaller as a whole, like as a piece of the overall pie. So McKinsey is not really taking a position, at least it doesn't look like it, but I am. And so you can see that the Alibaba's cloud business, because it was smaller, it grew at, in 2018 at 100%. It grew at 85% in 2019, 63% in 2020, 50% in 2021, and 23% in 2022. But if you were to use the average of those growth years and forecast it out into 2023, you would be wrong. And that's as simple as that. And so you can see for 2023, I'm actually growing the segment out at 10%. I think they achieved 10%. I don't think they achieved 15%. In 2024, I expect them to grow a little bit faster at 15%. And then I hope that that 15% growth rate holds into the next 10 years. And that is less than half of what they expect the Chinese cloud market to grow at. So do they grow at that rate, or do they grow much faster? A lot of the Patreons that follow this channel actually tell me that they expect it to grow a lot faster. However, they expect the China commerce segment to grow a lot slower. And what do I mean about the China commerce segment? Well, you can see that overall, OCED is expecting the Chinese GDP growth to slow. So gone are the days of the double-digit GDP growth levels. They expect 2022 to come in at 5.1% and the same number for 2023. So if Alibaba represents such a large part of the Chinese GDP with their China commerce segment, how can you expect that segment to grow materially faster than the overall GDP for the country? You really can't. However, notice the rate at which the total China commerce segment has grown in the past. In 2017, it grew 42%. In 2018, it grew 53%. In 2019, 40%. And it just kind of continued at that 40% rate until 2022, where you got cut in half. Now, recall, I was actually forecasting the 2022 segment to slow down. I think I was predicting 19%, so they even came under my number. But the reason for which is because China is just slowing down, and you sort of have to expect that into your forecast. And so you can see that in 2023, because of the lockdowns and just the global market slowdowns, I'm expecting the total China commerce to decline by 7.5%. Now, they're probably going to do better than that, but I'm just being pessimistic in my revenue assumptions for the segment. And then in 2024 and thereafter, I'm actually only expecting growth at around 7.5%. Now, a lot of the Patreons on our calls ask me, why is it that we're expecting China GDP to be at 5%, but I'm expecting total China commerce to grow at 7.5%, so 50% greater. And the reason why is because they are investing in very high growth businesses. And, a couple of those businesses are Taocaicai and Taobao Deals. I also believe that because those businesses are growing really fast, their logistics network is going to grow very fast as well. And it's going to sort of like help it all along as well. And so the logistics network grows out in another segment, but ultimately what I'm trying to say is that because they're so future focused and they're focusing in on areas where I do believe that they're going to take market share from a company like Pinduoduo, I do believe that they're going to become more competitive with respect to JD.com as well. I do expect them to outperform the Chinese GDP levels, but I don't expect them to outperform their historical growth rate. So we're just kind of in the middle there. You guys tell me what you think their growth rate should be. I think 7.5 is reasonable. Some may say that might be too low. Some may say that might be too high. You guys let me know in the comments below. And so overall, as I was writing this video out, their current share price was actually $67 per share. So you can see how much their share price actually has run up on the backs of them easing COVID policies due to the protests. But I still believe that the company's worth around $227 per share, call it $200 per share to be even. So it's trading at less than half of its intrinsic value. So this continues to be a value play. Now, notice that my valuation, notice that what's in the brackets up above, my valuation is net of the forecasted stock-based compensation. And what I'm really doing there, and I spoke about it, I'm starting to talk about it a lot more, is Alibaba is not a perfect company from my perspective because their stock-based compensation is very high. And so if we're going to forecast out Alibaba using free cash flow, what we really have to do is we have to assume a portion of that free cash flow goes to buy back shares that they're using to pay their employees with, right? Because you're going to get dilution from stock-based compensation being paid out to their employees. And so you have to buy that back with cash. And that's what this valuation methodology is doing. It's taking that into account. And I do believe that I'm the only person on YouTube in the finance space that's taking this complicated item into account. And I actually take this into account for every company that I evaluate on a cash flow basis. You don't have to take into account when you value the company on an earnings per share basis because it is expensed in the income statement. And so if you want to take a look at the Alibaba model and all the other models that I value on a cash flow basis where I'm sort of netting it out to come up with a free cash flow per share net valuation, you can join us at the Patreon at that lower tier. Now, I did mention that I did put together sort of like a 10 or 11 part series on Alibaba's Investor Day. And if you guys just want to get a reminder, because a lot of you may have watched it last year, you can get a primer or a reminder on what they said for their Investor Day so that you're primed for the coming Investor Day, which I will cover as they have it. And so to get to that video or that video series, click into this link right here.